Welcome to another virtual edition of The Bottom Line. Jim, the stock market's been doing quite well lately, going to new highs. It's all been driven by a handful of stocks. Apple hit $2 trillion in market cap back in August, and kept going for a while. We got to a point where just five stocks made up nearly a quarter of the whole market value of the S&P 500. It's not unprecedented, but it is unusual.
And it's scary, I think. A lot of people own, S&P 500 mutual funds. They're a favorite investment in 401k plans. And, 25% of your investment is just five stocks. You wonder about the diversification there. And they're really pricey. For instance, if you look at Facebook, it's 34 times earnings. Microsoft, 37 times earnings. An expensive stock is 25 times earnings. See, these are incredibly, I think they're just overbought.
Well, that did seem to be the case, and that's why, as we sit here in early September, the last 4 or 5 days, those stocks have kind of taken a beating. They've corrected quite a bit. I mean, Apple, I just checked, is down like 13% from its peak, which was just 4 or 5 days ago. Dominance always comes to an end, either by some other companies surging and gaining prominence, or by the leaders stumbling a bit. And it appears we may have had sort of peak tech for this cycle.
Well, if so, it's justified, because the rise in these five has disguised the fact that the rest of the market has not been rising that much.
Right.
And so maybe the rest of the market is not quite looking past the pandemic as much as the tech stocks have, because the tech stocks, of course, prospered in the pandemic. The other areas of the economy have been weak. And now, if we do get a vaccine, if we do see some economic revival, and we are seeing signs of economic revival, maybe there will be some rotation, and the beaten down stocks might have their day.
Yeah, no, that's true. I mean, I think investors flocked to those big tech names because those were companies that would not only withstand the pandemic, but in the case of Amazon, for instance, would actually benefit, and their business would grow because of all of the lockdowns and everything.
Oh, sure. Or the company that we're using right now to talk to each other, Zoom.
Yes.
They're up like
that stock has done very well.
400% or something. Yeah. It's astounding. It's time for some rotation in these stocks. The lesson here is diversification. You automatically get that with the mutual fund, or you're getting less of it with an S&P 500 now, but it will protect you in instances like this. Yeah,
I mean, and the lesson is, nothing is permanent. If you decide to concentrate your investments in these momentum stocks, that's a dangerous strategy. I mean, I think the generation of the 1960s learned that when there was sort of the nifty 50, and there was actually a time in the 60s when the likes of AT&T, ExxonMobil, IBM, just a handful of companies made up an even larger percentage of the indexes than it is the case today.
Yeah, so if you're going to diversify, let's say you have an S&P 500 fund, which gives you fairly good diversification.
Yeah.
You're going to want to add some international to that. You're going to want to add perhaps an extended market fund to that, or to get the small caps, which have been terribly beaten down, or the mid caps, which have been beaten down. Maybe with an economic recovery on the horizon, they will be the place to be. Certainly, perhaps foreign stocks, which are cheaper. If you're going to get a rational portfolio.
Oh no, I think those would be a better bet. I mean, one portfolio manager told me, he's he doesn't own Apple. He's he's a growth stock investor, but he's looking for smaller companies that have more potential and are more reasonably priced right now.
Yeah. I know personally, I've been lightening up on stocks for about the last month. Not selling heavily, but basically selling what I bought certainly back in March, because I look at those PE. The PE ratio on the S&P 500. Well, the S&P 500 is 37% trailing, 25%. Excuse me, not percent. 37% price earnings ratio.
Right.
Trailing 25% estimate. The long-term average is 16. Now you have very low interest rates, and part of the reason that stocks are so high is because there's no alternative to them. Interest rates are so low that the bond market looks overpriced, as well as the stock market. That's
right. And the Fed's just told us that those basically zero rates are going to continue for a very long time, for the foreseeable future. So we've had this debate before. I'm not in favor of trying to time the market. You look at you do get a little concerned when you see the PE ratios and the market being dominated by those few large stocks. But if there's a rotation, that's a healthy development, and we see some of the more cyclical companies start to take prominence. I think that's healthy, and I think I would not want to be out of the market now, certainly.
I wouldn't want to be out of the market, but I think I'm smart for lightening up.